Welcome everybody. My name's Stuart Wemyss from Pro Solution Private Clients, and I'd like to also welcome Paul Nugent, Director of Wakeland Property Advisory, who joins me on this webinar this afternoon. Welcome, Paul.
Thanks very much, Stuart. Good to be here.
Thank you very much, everyone, for registering. Hopefully you hear me loud and clear. If not, certainly adjust the volume on your computer, and if you continue to have issues in regards to volume, please feel free to sort of share them in the comments box, which you'll see on the top right hand of your screen. And if you don't see it, just click out the red arrow, and you can certainly type some messages into us, whether the audio is coming across clearer or not. In terms of today's presentation, we've got a formal presentation, Paul and I, that will probably last around 30 minutes. And what we really wanted to do is leave plenty of time to answer your questions. So we've got heaps of questions to sort of get through that people have submitted when registering, but certainly as we go through the presentation, we'd love to pick some current questions. So if you've got a question, just type it into the comments box, which again you'll see on the top right hand side of your screen. Again, if you don't see it, click out the red arrow. Type in your question there, and we'll pick up the topical questions that we think are quite interesting at the end of the presentation. We'll have plenty of time for that as well. Also, when you click out of the presentation this afternoon, when you finish, a feedback form will pop up, and we just ask you to sort of take a couple of minutes just to give us your feedback, just to make sure that the topic was useful, and also to follow up if you have any further questions or needs. And also, if you miss anything during today's presentation, don't worry too much. We will send you a recording in the next couple of days. So if you've registered, you'll definitely get a recording. You'll be able to watch it later. So without further ado, I'd like to hand over to Paul, who's going to sort of take us through why people fail to start investing.
Well, thanks very much, Stuart. I've been involved in property for nigh on 30 years, I suppose. And over that time, I've had countless interactions with would-be investors where it was obvious that they were never going to press the start button on investment. It wasn't because they didn't believe they could make money or that it was a bad time to enter the market. Nor was it a case that they didn't like my approach to property investment, I hope. But look, it was more for a far more primal reason than that. It was fear. You could see the anxiety in their eyes. The whole process was too much to compute. They were frozen into inaction. Of course, I've crossed paths with many of these people in subsequent years, and you know what's coming. The common refrain has been, why didn't I invest back when we met? Clearly, property investment can be a very worthwhile endeavour. The evidence of the last 25 years or so shows that. The regret usually comes around starting too late or not starting at all. As mentioned earlier, too many would-be investors fail to launch. They're intimidated by a process that seems to have so many complicated facets. Some are put off by the idea of finding the right property. Others run at the thought of securing finance. Another group come out in a cold sweat thinking about bidding at an auction. This afternoon we'll walk through how to deconstruct the process into its constituent parts and then knock each one over. As Stuart's about to tell you, the journey should begin with your finance. Stuart?
Thanks, Paul. So why is structuring your finance so important? Well, there's a couple of things, a couple of reasons why getting the loan structure correct is important. Firstly, it's going to make or break your investment strategy. For most of us, we need funding. We need to go to the bank and borrow some money. If that funding isn't available, obviously our plans aren't implementable. So the first step is really making sure whatever plans that you have, that you can go out and fund them. Secondly, the other impacts are going to be on cash flow, things like cash flow, tax benefits, risk profile, and so forth. So again, if we structure our lending correctly, we can minimise our investment risk by building buffers into loans and so forth. We can structure it correctly and maximise our tax benefits, which is going to have an impact on cash flow. And also around interest rates and repayment terms, again, is going to impact our cash flow. Now, why is that so important? Well, it's really important to, I guess, minimise your commitments, minimise your cash flow when investing. That way it gives you two benefits. Firstly, it gives you the flexibility to decide where to direct your cash flow from time to time, whether it be it towards more lifestyle assets or repayment of home loans, or even towards more investing. And secondly, just to bring out that last point, you know, if you minimise your cash flow and you've got more surplus cash flow, well, potentially you can allow you to invest more and grow your portfolio sooner. There's really three elements to get right when we're looking at sort of loan structuring and building an investment property portfolio. The first one is to maximise your borrowable equity. So we often talk about equity in property as the difference between how much the property is worth and how much you owe. But really that's only a theoretical equation, assuming you're not looking at selling the property. Borrowable equity is really how much can I borrow against the property. And it's going to be determined by a couple of different things: lender's policy in your own financial position, but probably most importantly, and this is the one that's a little bit more difficult to manage, is the property valuation. Valuations between banks can vary dramatically, sometimes by hundreds of thousands of dollars. So managing your property's value as far as from the bank's perspective is going to be a key element in helping you grow your portfolio. As you can imagine, if one lender is going to lend you X and another lender is going to lend you a tenth of that amount, obviously that first lender is going to be more attractive because you can borrow a little bit more sooner, assuming it's safe to do so, and build on your property portfolio. The second element is really minimising cost. Cost is typically a function of price, product and service. So what I mean, price is obviously interest rate, the product in terms of its flexibility and its appropriateness in your circumstances, and then service. What sort of service are you getting from your lender, how quickly they approve loans and deal with any issues that you come across. Typically you can choose two of these elements. You won't necessarily be able to optimise all three. But interest is going to be one of your largest, or probably the largest expense with investing, so it's important that you minimise it and also manage your interest rate exposure. The last point is going to be maximise tax benefits and flexibility. So obviously we all want to minimise the amount of tax that we pay. There's certainly no point in donating any extra to the federal government, that's for sure. So tax is going to be an element. It's not going to be the reason why we invest. We want to invest to sort of build our wealth, but certainly along the way there's things that we can do and loan structures that we can optimise to minimise that tax. And how you structure your lending, how it's secured, and how you draw it down, and how you fund your purchases, and what you do with your surplus cash flow, all will go to and have an impact on your tax benefits. So it's not difficult. I'm not making it any more complex than it needs to be, but often you don't know what you don't know. So it's really important that you get some good quality advice to make sure it's structured correctly. Lastly, flexibility. You want the flexibility to be able to go to a different lender, to get a different valuation, to lock in interest rates when the timing's right, to draw down on funds when an investment opportunity crops up. So if you can maintain your flexibility and agility in terms of funding and so forth, that's going to set you in good stead to take advantage of market opportunities. I'll hand back to Paul now, and he's going to take us through the next step.
Thanks, Stuart. And look, as much as it pains me to say, it is absolutely vital that you take care of the finance part of the property investment journey first. It will provide you with great clarity about your budget, which in turn will give you a good sense of the sort of property asset to focus on. After that, it's a case of applying a tried and tested method of asset selection. Now, some listeners will be familiar with the Wakeland Property Advisory philosophy. Others won't be. The former group can use the next minute or so to send Stuart a difficult question, a really difficult question. Property investment's about finding and securing scarce assets. I mean scarce in its purest form, where demand perpetually outstrips supply. It's this scenario that will deliver the end goal all property investors should seek: strong, consistent capital growth. But what do these assets look like in Melbourne, and where are they located? Well, generally they're found in the inner ring suburbs, around 2 to 12 kilometres from the CBD. They tend to be older style apartments, 1930s to 1970s, or houses on quiet, attractive residential streets close to amenity radiating infrastructure, public transport and good roads, quality schools and other learning centres, and quite often village-like shopping strips and entertainment precincts. However, not every property in these locales will be a performer. One needs to check the past performance of a target property either directly through historic sales information or through the sales price of comparable properties. Asset selection is a study in systematic and diligent elimination. It's about doing your research to narrow down the field to reveal the best of the best. Once you've found a suitable candidate, you can take the next step, which is negotiation. And the first thing to say is that the process of negotiation actually starts from the moment you meet the first estate agent. What you say in that conversation may help or hinder you when it comes to the pointy end. So be careful what you utter, even if you feel you're months away from buying. The one piece of information never to let slip is your budget. This flags to an agent how much you are willing to pay, what your capacity is, and they'll try and extract every last cent from you. Also be careful about giving this information away indirectly by talking about what properties you have been looking at. Negotiation is much easier when you have a good sense of fair market value. If you've done your hard work burning the shoe leather in preceding weeks, you can face the negotiations with confidence. You will not be flying blind. Remember that you're buying a property for investment purposes. It's a cold, hard commercial transaction. You're after the right property that makes investment sense within a selling range. Be prepared to walk away if the maths doesn't add up. That's so much easier if you don't fall in love with the property. This is not about emotion. If you're buying at auction, the negotiation process will actually be very transparent, at least to begin with. Everything is done in full public gaze. In some ways, this is easier than any other sort of negotiation you need to undertake, as long as you are clear about your financial limit. Generally, proceedings unroll in a predictable manner, and he or she with the most money wins the prize. Do make sure you come along with a cheque representing the minimum deposit asked for in the contract. Naturally, you don't know what the property will sell for in advance, so work on the basis that you spend your entire limit. Often a good idea is to speak to the selling agent before an auction and try and have a predetermined deposit payable. It's amazing how many successful bidders don't actually have the deposit. They usually muddle through, but it tends to be awkward, which you don't want to be as the buyer when you have to liaise with the vendor or the vendor's agent over a number of things in the following weeks. The number one rule at auctions is to ensure you have the highest bid if a property is passed in. Your job as a prospective purchaser is to either buy the property or to have it passed into you if it is within your capacity. It's something agents drone on about constantly in their preamble and during the auction. And there may be many parts of an auctioneer's spiel that's puffery, but this part certainly isn't. The highest bidder is in the box seat when it comes to negotiations, and I can assure you that 9 times out of 10, they secure the property. Should you find yourself in an after-auction negotiation, you'll probably be invited inside the property. But say to the agent, with the invitation, no thank you. It's far better to remain outside. First, it means the agent will find it harder to pressure you. Secondly, and very importantly, you can see whether anyone else is hanging around who may want to buy the property. If not, the agent can't play the old trick of telling you that he has another buyer lined up outside. So, stay outside the property. Okay. Settlement. So, if you succeed at negotiations, congratulations, you've reached stage 4, which is the settlement process. It's perhaps the least understood part of the whole game. The name alone conjures up the thought of old grey men filling in dusty ledgers. It's the world of solicitors and conveyancers. Look, let's be frank, it's even duller than the finance part of the campaign. Fortunately, you can get away with not having to learn too much about it. The key is to get a recommendation for a good solicitor or conveyancer to do the work. So ask around, well before you're in a position to buy. Stuart, what are financial considerations?
Pretty simple, Paul. I mean, the lenders and the conveyancers all meet in a room. It happens physically, and they'll swap checks and titles and so forth. So there's nothing really the client needs to be involved in. The key element, though, is making sure the loans are drawn down correctly, and mistakes do happen. Banks pay out the wrong loans or draw the wrong loans and so forth. So make sure your banker and broker is over the top of it and can manage that aspect. And the last aspect in terms of settlement is just making sure, again, your loans are structured correctly, that any offset accounts are linked, that any cash is sitting in offset accounts, you've got bank accounts ready to receive rent and make repayments and those sorts of things.
Okay, look, thanks. And look, one other property aspect to think about here is a key part of a conveyancer's role is to make sure that you as the buyer are getting what you are promised in the contract of sale. So to make sure that all the checks and balances are sorted out, as Stuart mentioned, but also to make sure that title and zoning particulars are correct, and that the property is the property, and to ensure that you're getting what you pay for. And look, that really moves us on to property management, which is the next step. So we're almost home and hosed. We advise investors to try and hold property for at least 7 to 10 years, and ideally buy, hold, never sell, and repeat the process. So the reality should be this: purchasing property will consume a few weeks or perhaps even a few months of your life, but managing the property is a long-term commitment. As soon as you buy a property, the first thing that will likely happen is that the vendor's real estate agent, the person who sells you the property, will approach you with their $1 million smile and try and persuade you to use them as a managing agent. It's a really great day for an agent when they receive a commission for selling the property and another one for picking up the management. But don't accept this easily. Property management is a specialist field. Some agents do it well, most don't. And just because you're dealing with that particular agent doesn't mean that you should be going down that path. You should approach selecting a property manager as you would a new recruit at work. Get recommendations, undertake a thorough process of interviews, seek references. You're looking for the agent who has a track record of sourcing and keeping good tenants. Don't look for the agent with the lowest fees. It's usually a false economy. And finally, a quick word about whether one should renovate before leasing out a property. This is very commonly asked at the moment. Our general advice is to buy investment properties that don't require much in the way of renovation. This minimises the additional cost of property, especially around it being unavailable to earn rental dollars whilst it's being done up. The aim is to undertake relatively inexpensive cosmetic renovations that do give you a fair degree of bang for your buck. Note that the jump in supply of new properties that have been released to the market in more recent years has meant that tenants are actually spoilt for choice at the moment. So these older style or established properties still more than hold their own in the marketplace in terms of position, in terms of capital value, and in terms of likely capital growth. But we now advise clients as they move into the phase of becoming a landlord to give additional consideration to ensure that their property has contemporary features such as air conditioning or heating, or perhaps even it might be doing up a kitchen or a bathroom at some point, but just keeping that property relevant and competitive with what else is emerging out of the new property sector. So now what we can move towards is talking with Stuart about portfolio review.
So this is a sixth and final step in the process to investing, and investing is not about going out and buying a property, closing your eyes, crossing your fingers and hoping it's all going to work out for you. Really, at the end of the day, it's your money and it's your responsibility to make sure it's working as hard for you as you expect it to. So really what we need to do is conduct a portfolio review at least probably annually. It might not necessarily result in sort of implementation steps, things to do, change, etc. But it's really important that at least every year you sort of stop, take a bit of a breather and run the ruler over the performance of your assets. The first thing is going to look at the performance of the property. So you'd want to, obviously we invest in property primarily for capital growth, so that's going to be most of your attention is paid to that. It can be quite difficult, particularly in the earlier years, because property growth is rarely straight line. That is, the market's going to move spasmodically. Some years it's not going to move at all, and you might get some years, maybe a couple out of every 10, every decade, where there might be a little bit of price depreciation as well. But essentially, your focus needs to be on how sure are you that this property that you own is going to double in value every 7 to 10 years, and that's sort of perpetual capital growth as well. So you don't necessarily need to see the growth to see that, to become certain of that event. Obviously, in the early years, you might not, but certainly if you held a property for, again, 7, 8, 9, 10 years, you certainly want to be in a position where you're seeing some level of capital growth. The second element you want to look at is cash flow and your own financial position. So there, you'd be looking for things, is there anything I can do to optimise? What am I doing with surplus cash flow? Am I directing it in the right places? You know, do you repay the home loan? Do you make another investment? Do you make additional super contributions? And also looking at your existing loan structure, interest rates, and those sorts of things. You want to look at the property manager and the property's performance from an income perspective as well. And are there any sort of capital expenses improvements that you need to make in the next year? The last step in terms of doing a portfolio review is really looking at risk mitigation strategies. So looking at your insurances, particularly landlord insurance, income protection, those sorts of insurances, to make sure that if the worst is to happen, is something to go wrong, that you're well protected. And the last step in terms of portfolio review is going back to your original plan and seeing if you're kind of on track in terms of what you wanted to do to build your asset base and fund retirement. And particularly there, I'm talking about, is it a good time to make another investment, or do you have enough investments under your belt? And typically I find people get sort of distracted by life. You know, life's very busy. We've all got sort of urgent, important things to do. And quite often our own investment strategy suffers. So we tend to procrastinate, we blink our eyes and the 5 years have gone past. So it's really important to deliberately sit down every year and ask yourself, okay, does my financial position lend itself to making another investment, and is that appropriate for my situation?
Yeah.
Paul, do you have anything to add?
Well, you know, look, it's interesting, Stuart, because really that annual review, which is critical, I believe, for successful property investment, it's a great time just to touch base with the property managers, sit down with them, obtain a verbal report on tenancy and the property, and provide them with a bit of feedback on how you feel their performance has been to date. But it's a great time to just devote a brief amount of time to building a bit of rapport with that property manager.
Excellent. Well, that concludes the, I guess, the formal part of today's presentation within the webinar, and now we're going to turn our attention to answering some of your questions. So certainly we've got a bunch of questions to get through, but we'll pick some ones that you type in now or during the presentation. So if you've got any questions you'd like answered, certainly take the opportunity now just to type it into the chat box, again on the top right-hand side of your screen, and we'll jump into them. So the first question, Paul, is from Patrick. It's really a one for both of us, I guess. Patrick asks, is there any insights or one insight that you would have shared with investors 10 years ago when you met us both compared to today? So has anything really changed, your advice 10 years ago compared to today?
It's a good question, Patrick. Thanks. Look, it's interesting to think about that, because I suppose in terms of asset selection, where to buy, what to buy, nothing at all has changed. You know, we're still offering clients and prospective clients the same advice in terms of the type of property to invest in, because we can see now 10 years later just how well they've worked. So we're not going to change that sort of advice. What, of course, has changed, which is a bit, you know, self-supporting in a way, is the price range that is necessary now to buy those sorts of assets, because we've seen such tremendous growth in them that people aren't able to come into the market, obviously, with the same expectations in 2015 that they'd be able to buy the same assets as they could have in 2005. But most certainly, the type of property that you should buy and the type of property that's going to continue to work in the future is the same. But look, Stuart, in terms of finance?
I think my answer is going to be pretty similar to yours, Paul. Right from the beginning, I've been saying that it's pretty simple to build wealth. You just do it when it's appropriate for you, so you don't need to push the envelope, take ridiculous risks, you know, go and buy 3 properties tomorrow. Just do it deliberately and regularly and safely when your situation dictates it. And secondly, and probably most importantly, the quality of your assets will determine your outcomes. Be it property, shares, or any type of investment, you can't invest in below average quality property and expect above average quality returns. The only way you're going to get above average quality returns is if you invest in above average quality assets, and that's appropriate to property as well. So really, if all you do is go and buy the best quality property your money can afford, when it's right for you to do so, and repeat that process and manage your risk appropriately, then you'll be very successful. And my advice probably hasn't changed there, Paul.
Okay, well, it's remarkably consistent. Thanks, Stuart. Look, David wants to know more about structuring the transaction. What are the watch-outs, in particular with respect to the use of equity in the principal place of residence and so on?
Thanks, David, for the question. And it's not an uncommon one, particularly when people embark on a strategy and say, look, we've got our home, we've worked really hard to repay the home loan, we own it outright now, we've got the title, and we don't really want to risk it naturally, and which is completely understandable. The first point is always borrow safely. Borrow within your affordability limit, and think about all the things that can go wrong and mitigate them. So, having good quality income protection insurance is one of the things that jumps to mind. Firstly, because really, if the risk of defaults, the risk of you not being able to make the repayments is low or even non-existent, then it doesn't really matter what we use to secure the loans. It could be your home, it could be your wife, it could be anything. It's not really going to matter because it's not at risk. But if you do need to use the home and you really are concerned about the risk, one of the key aspects is not cross-securitising your loans. So making sure loans are individually securitised, that you're not tied to one particular bank, or the bank doesn't have sweeping control of your overall equity. Look, an explanation of this really probably is a little bit more detailed than this presentation lends, but there's certainly a lot of, you could just Google cross-securitisation, there's plenty of articles that I've written about that. Paul, Tracy's got a question around property management. So how do you find a good property manager and how do you manage them? I'd like to know too, actually.
Thanks. It's a perpetual question because, like buying the right property, it's all in the selection of the asset, and I think it's the same when you're selecting a property manager, someone you have to work with and have a long-term relationship with. And look, it can be done in numerous ways of doing it, but I suppose for those who haven't bought an investment property before, I think it's a matter of dealing with a local agent who's got a proven track record. So you'll probably get a fair idea of that by using it and seeing who the preeminent agents in the area are for rentals, and then going and interviewing them. I mean, I had a client once who I thought was particularly clever and a very experienced property investor, and she used to actually go and interview managing agents as if she was a prospective tenant to see what sort of response they offered. So that was how she initially sorted out the wheat from the chaff. But look, once you've actually appointed a property manager, I think what you need to look for is the communication that they give you and their accessibility. I think there's nothing more frustrating than having a property manager who is very hard to get hold of, someone who only emails you and isn't available on the phone. This is about developing a rapport and a relationship. I think it needs to start by having a meeting, effectively an interview, a job interview with these people. Once you're satisfied that you've appointed the right person, making sure that they contact you if ever there's an issue to be discussed, that they know that you are available. And if you actually have that sort of relationship with them, it can be pretty much a hands-off relationship, and you'll be able to develop some sort of bond, and there'll be an element of trust. So I would suggest to you that that's probably the best way to do it. Stuart, something that's quite relevant at the moment. We've got someone who says, now 59 years of age with no self-managed super fund, but has been advised to set up a company to buy property instead of a self-managed super fund, and then a trust fund for that particular property. What say ye? It's supposed to be equally flexible, cheaper, quicker, and will isolate the property from litigation.
Thanks, Paul. Well, from what I read between the lines of this question, I think the client, this person, sorry, been advised to use a trust with a corporate trustee to purchase the property as opposed to a self-managed super fund. And I guess the listeners shared their age 59, as a way of, I guess, hinting whether maybe, given they're approaching retirement, that a self-managed super fund might be more appropriate. It's difficult to answer the question without obviously knowing the full details of the financial position of the person involved. In terms of trust versus self-managed super fund, obviously a self-managed super fund has a lot more tax benefits in terms of potentially zero tax and zero capital gains tax if you utilise the property in pension phase, and only 15% tax during the accumulation phase, which is the phase just before or until you retire. If you're nearing retirement, it can be a great vehicle. If you're not that close to retirement, one of my concerns is that the government has too much control over super, and the taxation thereof, and I think that the easy way for the government to raise more revenue will be to increase the amount of tax superannuants pay, and particularly people that have a reasonable amount inside superannuation. So, you know, if you're being too super-centric, too super-focused, I think that can be a negative as well. Land tax can be a big one as well. Land tax inside a trust, particularly in Victoria, you're going to pay more land tax. But probably the easiest answer I've got to this question, a little bit of a plug. I've written an ebook that's called Tax Busting Structures that talks about all the different structures we can utilise with property and the pros and cons. Happy to give anyone that ebook. So just contact Pro Solutions office and they'll certainly be happy to email out that ebook to you. And maybe that's probably the quickest way of answering that question.
Okay.
Paul, on to the next one from Cavi, which is one I sort of talked about, maximising your borrowable equity, which really goes to maximising the valuations of your property. Cavi mentions it seems like it depends on the mood of the valuer of the day, which I kind of, I guess, a little bit agree with. So if I've got an investment property portfolio that I want to get revalued by the bank, how do I best go about making sure I get the highest valuation possible?
Yeah, look, interesting question, and Cavi, I think that your molecules are aligned correctly, because it's actually very subjective on the part of the valuer as to how they're going to approach your property. I mean, when a valuer is assessing your portfolio, chances are they're going to be comparing your particular properties to those others in the area that are known as comparable transactions, comparable properties that have transacted. That gives them an idea of baseline value. However, the valuer won't have inspected those properties. The property that they're going to inspect when they're looking at assessing your portfolio are your properties. So in the same way that if you're going to get a valuation done on your car or whatever, or you're going to the dentist, brush your teeth, wash your car, present your properties as best you can. Not always easily done where properties are perhaps tenanted, but the best advice I can give is to make access easy to a property, but to present them as you would if they were being sold. So the better you can present them and the better they look, the easier it's going to be for the valuer to do his job and to come up with perhaps, you know, favourable notions of value. Okay, so I hope that helps. Thanks very much, Cavi. Look, Jason wants to know, Stuart, whether the banks have tightened up the rules for lending. What sort of LVR is now required?
Thanks, Paul. I wrote a blog yesterday that's actually published on Pro Solutions site, so if you want to read that, just go to the website, about the changes that the banks have made over the last couple of weeks. And Paul and I were talking about it actually before the webinar. I think they're the most significant changes in credit policy in certainly the 13 years that I've been in business, and even more significant than the changes they made during the GFC. So lenders have certainly pulled back borrowing capacity. The direction from the government is, and the government's putting APRA is putting quite a squeeze on the banks, and certainly I know a couple of transactions and issues we've had over the last couple of weeks we've never encountered before. And they're putting the squeeze on the banks to essentially halve the amount of investment lending. So really, for every 2 people they're lending to at the moment, they want them to lend to 1, and they're doing that by tightening credit policy, so making it harder to get the money. So that's an issue for some people. Now, if you're borrowing and it's right for you to do so, and you're thinking about all your risks and you're borrowing safely, etc., I probably think you'll be a lot less affected. What they're trying to probably is get rid of the people in the market that are just a bit sort of too gung-ho-ish. It's really important to obviously utilise either a broker, or if you're going to do it yourself, get the right bankers in place to make sure they understand your situation, so you can really work out which is the best lender for your particular circumstances, particularly in a changing market. So I guess overarching answer would be there are some major changes out there, but if you you know, if you are well placed to make another investment, get some good advice, and you'll probably be okay. Okay. Paul, I've got one from you for a question for you from Margaret, and it's probably one you may or may not be, having known you for the last 10 years, sick of answering. But please provide, Margaret asked, please provide an opinion on the Frankston property market. Will it ever take off?
Look, it's just been a perennial question, Stuart. People have been asking me the same question since about the year 2000, I think, because you know, many commentators have for that length of time been saying that Frankston is the next Albert Park because it's by the water and it's undervalued, it's reasonably priced, it's got so much going for it. And yeah, there's certainly an element of truth to key attributes that sit around Frankston. And there are pockets of Frankston that are extremely valuable and highly sought after, particularly around Oliver's Hill. However, look, what you'd have to say, generally speaking, is that if we consider that the driver in capital growth is the scarcity of land and the attraction of living in a particular area is related to the amenity of that land, whilst there's nothing wrong with Frankston per se, because of where it's located and because of the amount of land and the amount of areas that it's accessible to, there's never going to be that intense pressure on land value and that intense pressure on land usage that's going to create extraordinary capital growth. So once again, whilst it might be an area that's very attractive for a number of people to consider living at, and I have no doubt of that, I can see absolutely not one reason to contemplate buying an investment property, a residential investment property in Frankston if you're looking for above market capital growth. It's not going to happen. So anyway, there are all sorts of theories, and you know, I suppose if property hasn't shown its hand as demonstrating extraordinary capital growth over the last 15 years, you'd have to ask yourself, when is it going to? Look, Stuart, someone's asking here, in fact it's Sonia, how can I find a one-stop strategist to help review my current investments, maximise their potential and help me move forward?
Thanks, Sonia. A one-stop shop always seems pretty appealing in terms of going to one person. They understand your full situation, and they can deal with you and help you through the investment journey, and you don't need to then coordinate a whole bunch of other advisors. There's probably two responses I'd make, however, to that question in answering that question. The first one is that ProSolution, my business, is a financial services business, and it'll always be that. We're not a property business, we're not a share broking business, and so the benefit of that, and we want to maintain our independence, and the benefit of that is that clients can come to our office and we can talk about their financial position, what they should do, and we won't make any more or less money whether they invest in property, shares, or do nothing. And that's really important from my perspective. So, because I always want to be in a situation where we're offering unbiased and quality advice. So I'd be a little bit careful about going into a business that can give you some tax advice, set up your loans, and sell you a property as well. Typically, and I'd say almost always, that business is making commission on the sale of the property. Not every single property is going to, or seller is going to pay this business a commission, and typically they're going to work for a whole bunch of developers and sell you some pretty ordinary quality property. And I've seen some documentation from clients that have been elsewhere before they've come to us where the advisor's making $20,000 or $30,000 in commission by selling this person a property, plus then their home loans, etc., etc. So, you know, you just can't, in my opinion, feel comfortable about the quality or get comfort on the quality of advice when those sort of commissions are in play. Having said all that, obviously ProSolution and Wakeland Property Advisor have had a really strong working relationship for nearly on 10 years now. And what we're recognising is that we do really need to service our clients' needs, and hopefully in the one position. And it was only just before this webinar that myself and Jordan from Wakeland had a meeting with a mutual client. So we're quite happy to meet clients face-to-face, where someone from Wakeland, someone from ProSolution can be there, where we can cover off on, you know, financial advice, lending, property selection, all those sorts of things at the one meeting, and it tends to work really, really well. But what I would really make clear is that ProSolution and Wakeland are just working together. There's no financial affiliation. We have never paid or received a referral commission, and neither has anyone from Wakeland. So the benefit of that is that we're still maintaining our independence, and if we have a joint meeting and I don't think it's right for you to invest again, I'll be quite open in front of Wakeland or not to say, okay, this is it, you shouldn't invest, hold still, it's not within your risk profile. So we're working hard on providing a good solution that still maintains our independence and still puts the client first, but just be wary about a one-stop shop. Paul, I've got another question for you from Christella. She asked, do you still see the same tremendous amount of growth in the next 10 years? I guess obviously she's referring to the property market there, and I'd probably just extend on that. Obviously there's been a bit of talk about a property bubble and how much can property grow and so forth, and there's always that question where we talk about the property market as one homogenous group of assets. But maybe if you can sort of answer Christella's question from that perspective, is what do we see the growth prospects being like the long term in the Melbourne property market?
Look, it's really hard. Thanks, Stuart. And Christella, it's very hard for anyone to have a crystal ball. I think what I like about your question is actually that you're projecting 10 years down the track. I'm probably more comfortable suggesting to you that, what my prediction might be for 10 years as opposed to 12 months or 2 years. Firstly, it is a guesstimate that I'm going to talk about now, but it's based in experience for, as I mentioned at the outset, nearly 30 years of time spent in town planning and property work. Look, I think the growth is going to be related to the selection of the asset. It's as simple as that. And I would suggest to you that for those who buy the right asset now, they will see a doubling of value in that asset over the next 7 to 10 years. It's as simple as that. Where people are going to come unstuck is when they buy the wrong type of property, and it's been the same. It was the same 10 years ago. It all comes down to the selection of the asset. We will see interest rates perhaps come down further. We will see interest rates go up. We will experience changes of government, Liberal, Labor, whatever. There will be all sorts of things happening, changes to legislation. But I can assure you that a scarce resource that is always in greater demand than supply will continue to perform. So we're very conservative here. Let's look for those that always work. I think the current environment, which is underpinned by, yes, low interest rates, but also something that many of us tend to forget is that we actually have very strong population growth, particularly those coming from overseas. So look, be confident, but you don't need to be doing anything outrageous or outlandish. You do not need to be looking for the next big thing. If you are conservative and buy the right type of property now, I'm sure in terms of capital growth you'll be very well rewarded in the next 10 years. People were asking the same question 10 years ago, 12 years ago. Can we see the continuation of this growth? And for those who bought the right property, we most certainly have. So I see no reason why that won't continue. But anyway, look, question from Sanjay for Stuart. Regarding structuring of the loan, whom to approach or the key person to speak to? Does this process have to be done before we finalise a loan with the bank? So, yeah, who's the best person to speak to, Stuart, and when should one do that?
Thanks for the question, Sanjay. Hopefully it's a pretty quick and simple answer. And I know this sounds very self-serving, but I can't really understand why someone would not choose to use a broker instead of going direct to a lender, particularly in today's market where credit policy is changing quite quickly amongst the lenders from lender to lender. So I think the answer for me, and even though it might sound a bit conflicted, would be to go and find a good mortgage broker that can do both. One, give you a good quality sort of loan structure and advice and help you maximise and minimise all the right things that I've spoken about today, and then secondly, go and implement that advice. Because you need to make sure that whoever gives you the advice is also implementing it so nothing kind of gets lost in translation. So I hope that helps, and I realise that's coming from a mortgage broker myself. So, but of course I believe in what I do. Paul, I've got a question from Sarah, and she's asking, how quickly would you drop a dud property? So obviously, especially if you've already paid acquisition costs and stamp duty and so forth. I think it's a really good question from Sarah. How quickly do you know before you make the decision to exit and potentially reinvest somewhere else?
Well, so the question, yes, thanks Sarah, thanks Stuart. I suppose what you really have to do is quite genuinely track the performance of a property over a few years at least to begin with, and see, because we don't expect property to necessarily grow on a year-in, year-out basis. Even top-performing assets that grow by 10% annually don't necessarily increase in value each year by that amount. Sometimes they can go through a very slow or low growth period of 2 to 3 years. Then they might grow by 20 or 30%, do nothing for a couple of years, then grow by 30%. On it goes. This is why you need to actually generally hold a property for 10 years to see it perform. However, Sarah, if a property is a non-performer, you can tell within 2 to 3 years of ownership. And look, there are a number of ways of determining that. One, of course, is by looking at its value and being able to project what it's worth in the current market compared to what the price was when you bought it. Secondly, it often comes down to your experience with the tenancy, and have you had stable tenancy there? Have you had rent increases? Have you had lack of maintenance issues? How's the property stood up over time? These are the sorts of things that you want to look at. But most certainly, I think, for anyone who's gone to that dreadfully high expense of buying a property, where buying in with stamp duty and whatever other fees there are, it's a bitter pill to swallow, and to try and turn around after 12 months and sell a property is probably a very big ask. But I think that if you feel that a property is a dud, I would certainly look at doing it sooner rather than later. If you realise your mistake early on, I would still wait 2 to 3 years and then know that I was making the right decision in terms of disposing of that and putting your equity or your capital or your loan servicing capacity to greater use by buying the right sort of property. I mean, you've got to remember that it actually costs no more to be servicing a loan on a property that works and shows strong capital growth than it does on servicing the loan for a dud property. It's just that it takes a number of years to find this out. So there you have it. I hope that helps. Look, Stuart, there's been a suggestion of getting rid of negative gearing. How do you think that would affect the markets? Rain has asked that.
Thanks, Rain. I think the easy answer is that I think it's almost certainly wildly unlikely that the government's ever going to remove negative gearing out of the market. I mean, they did it in the 80s. The property market didn't react very well. I mean, there was a bit of price depreciation around that time. It was only for a few months before they reinstated negative gearing and the market got back to normal again. Obviously, if you remove negative gearing, it increases the holding costs of a property. And I think the flow-on effects of that would be increased rent. Because me as an investor, if I'm making less money, I'm going to try and push that out to whoever's paying my rent so that my shortfall is going to be the same. So it's really going to increase property ownership, the cost of property ownership from an investor's perspective, and that's obviously going to filter down to the rental market. So it's going to increase housing affordability, whether you're a renter or an owner-occupier. And so I just think the flow-on effects and the property market implications and so forth, and also just the political implications. I mean, imagine trying to get re-elected or elected if that's what you're campaigning on. It's just not going to happen today. I don't know if Paul's got any thoughts to share on that.
Yeah, look, thanks, Stuart. Yeah, look, it's interesting because it's very easy to hold negative gearing up and suggest that it's holding back the market for first home buyers, and I suppose in certain circumstances it might be. However, I think the nub of the issue that we're talking about here is probably one of supply rather than one of tax planning or strategy that sits around this. I could be wrong, but I just get the feeling that there's a bigger problem at play here, and that problem is probably trying to marry first home buyers' expectations with what's in the market, and then you've got to look at the attractiveness of those properties, because that often stems back to the infrastructure that has or has not been created that services those properties. And there's some pretty big questions to be asked here, and I just don't know that the obvious and the knee-jerk response by perhaps filtering negative gearing or by chipping away at the edges is going to really have a positive impact for first home buyers or anyone else in the short or the long term, Stuart. So yeah, thanks for asking that.
And look, I think if you do subtract gearing and the benefit of gearing, which is really only in the materially on the first 5 to 7 years of owning a property, if you subtract that from the equation, if you're getting a strong capital growth rate, so 7 to 10% compounding, the investment's still going to work. It's still going to be worthwhile to make. But if you're getting less than 7 to 10% compounding, obviously it's going to make the investment, a loss for you. So it's really important then to get the asset selection right. If you've got the asset selection right and you're investing in the best quality property, then whether gearing's there or not isn't really going to make or break the investment.
Particularly in a low interest rate environment.
Correct. Paul, I've got a question here from Mark and Lee, and I'm going to combine the question because it's a bit of a price point question. So Mark asks, is it still feasible to invest in the Melbourne market, and if so, which suburbs would you look at? So I guess Mark's hinting there at the price increases and how much it costs to get into an investment.
Yep.
And Lee's asking, if there's available for $1 million to invest, how do you spend it? Do you spend it on one property or spread it amongst two $500,000 properties?
Okay, both really good questions. Thanks for filtering those through, Mark and Lee. Yeah, look, it is still feasible, obviously, to invest in the Melbourne market. But once again, this is about selection of the asset. So the dollars that you're investing now will probably buy you less than they might have in the marketplace 10 years ago. However, we can buy a first-class, and when I say we, I mean the royal we, any of us, can go into the market and buy a first-class residential asset anywhere from about $450,000 to $500,000 upwards. Now, sticking to those areas that are 2 to 12 kilometres from the CBD, if I was entering the market with that sort of funding in place, and I'd spoken to perhaps Stuart and knew that I could comfortably buy a property at that level, I'd be looking for a really first-class one-bedroom apartment with car parking in a really good suburb, really good street, right position in the block, in good, comfortable order. And buying a property like that, they are not making any more of them. So you can buy a scarce asset that will perform extremely well in terms of capital growth over the next decade or so. What to do if one was entering the marketplace with $1 million? Once again, really good question. Should you buy one property or two? It comes down to, I suppose, risk profile and what you want to do. At $1 million, you could buy one really first-class Art Deco apartment, renovated Art Deco two-bedroom apartment in a small select block in a really first-class residential area with car parking, as I am prone to always bang on about. Or you could buy a really good single-fronted house in a great suburb. So what does that look like? I think you'd be looking at a really good little house in Prahran, Richmond, Fitzroy, Kensington, Flemington, Ascot Vale situation, or you might be looking at a really great Art Deco apartment in a South Yarra, Middle Park, Albert Park, if you could find one, Armidale, Hawthorn, but just something absolutely outstanding. The flip side to that is you could take $1 million and buy a couple of apartments, perhaps two one-bedroom apartments, 60s, 70s apartments, or even you might even be able to get an older style 1930s Art Deco apartment. As long as they have car parking, as long as they are in great streets, right position in the block, nothing to fear at all. And in fact, the benefits of buying two properties is that you're hedging your bets, where you don't expect the same sort of performance out of two different areas at the same time. You actually have covered off, and if you want to sell one and hold one for the longer term, it just gives you a bit of flexibility having the two properties. On the other hand, if you buy one property, you might actually be able to buy a property that actually has such a range of features that you'll actually get a greater rate of growth, believe it or not. So I hope that helps with that. Look, Stuart, Luke's asking a question here. At what point would you recommend that a first homeowner should consider investing in an investment property rather than paying off the existing mortgage they've got?
Luke, good question, and it's really going to depend on your circumstances and what might transpire in the future. I tend to think that you want to benefit from the compounding effects of capital growth, and so if you want to achieve that, obviously investing more sooner certainly pays massive dividends in the long run, but you want to do that safely. So if your home loan is kind of at a manageable level, I mean, everyone would like to have nil, but if it's at a sort of manageable level, then I think, and you've got a bit of equity in home, then I think it's wise to give consideration to investing, particularly in this market where we can lock in interest rates for, 4.5% for 5 years. So the cost of holding a property in the next 5 years is going to be very, very minimal. So it's a good opportunity and possibly the best opportunity. I don't know if we'll see fixed rates at this level, perhaps in my lifetime again. Certainly not in Paul's.
Depends how long you live.
However, if your home loan's considerably large and you don't have a lot of equity in the home, then you might be better off just spending the next couple of years trying to repay that as much as possible. We're getting short of time. We've got enough time, luckily, to ask one more question from Paul. Paul, this one's from Rain. He says, how do you review the financial performance of the property without necessarily ordering a valuation?
Okay. Well, Rain, I suppose this comes down to having an annual review with your property manager, and at the point at which you're reviewing the performance of the property manager, the rent you're getting, making sure that the tenants are paying the rent on time, that there are no issues in terms of repairs with the property. So hopefully after 12 months or so of ownership, all that's settled down. What you also want to know is, what is the property worth, just in a general sense. And I think any agent worth their while, particularly if they have a strong sales component to their business. So bear in mind that most real estate agencies comprise of both a property management arm and a sales arm. You should be able to be given an idea within about a 10% range of the current market value of the property. And often it's a really good rule of thumb. If you yourself aren't out there looking week in, week out, checking out what value is doing for properties comparable to your own in the same location, finding out from an agent who's conducting a number of sales in that location, they should be able to give you good evidence that suggests a fair range for the value of your property. So I hope that helps.
Thanks, Paul. And obviously it's something that Pro Solution and Wake can get involved in terms of reviewing our clients' portfolios. So if a portfolio review is something you feel like you need or want, certainly either Pro Solution or Wake can certainly help you with that and take you through that process. We're about out of time now, so thank you very much for listening in. There's just a couple of sort of quick housekeeping things. If you didn't catch all the presentation today, or you want to sort of re-listen to some of the presentation or answers and questions, you will receive a recording in the next couple of days, so hang in there. It'll take a couple of days to sort of get across to you, and you'll be able to watch that at some point. Also, when you sort of click out and close out of the webinar, a questionnaire survey should pop up. If you wouldn't mind just taking a minute or so just to complete that, to give us our feedback, that would be greatly appreciated. And lastly, I'd just like to thank Paul for joining us, on behalf of Paul and I, sorry for joining us. Paul, the pleasure has been all yours.
It most certainly has been, Stuart. It certainly couldn't have been yours. So I hope you've learned something.
Excellent. Okay, thank you very much, everyone, and until next time.
Okay.